Hello, everybody, and welcome to Confident Compounding with Corey Kramer. Today, we're going to talk about Celsius Holdings. It's going to be a buy, a little heads up there on that. So earlier this year, I made a promise or a goal that I would at least have a public buy video on a stock every 2 months. So there would at least be 6 per year. I think we're over 6 because in April we had quite a few. But my last one was in September. I think in my next video, I'm going to be selling one of those stocks in the next day or two. So I'll go over and we can look at what the holdings are right now when I do that. I think the last one was Align Technologies, which is, I think it's up a little bit since I made that buy video. Today's is going to be Celsius Holdings. Now in the market right now, it's very back near all-time highs again. So one of the reasons I haven't had too many, why it's been a couple months basically since I had a public buy idea, is because it's been pretty hard to find stuff. Now I do have weekly picks over on Patreon for $25 a month. There's a free tier over on Patreon too if you want to check that out. And so I have been buying things, but I'm committed to buying something every week for the weekly picks. And honestly, some of those were stocks that I already owned. And I think, a 3 out of 5 of the past, over the past couple months, the returns on those haven't been great. It's just been pretty hard to find good stocks at good prices at the same time. Especially if you're not quite going all in on like the AI themed things and the meme stocks and everything, which I don't really do. So Celsius Holdings, I own this one, it was a weekly pick almost exactly a year ago. So yeah, almost 52 weeks ago. So, and it's up about 35% since then. So it was a good weekly pick. I owned it even before that, I think, in the full service. And so one of the reasons, we'll look at the valuation. I'll look at a time until payback analysis here in just a second. As always, not individual investing advice, just how I analyze stocks. But I want to make sure I get my adequate number of buys. This will be the last one I have to make this year. But if anything good comes up, and I haven't made a public buy video, I'll definitely make more if there's more available. So I have owned this one for a while. Now, my thinking on this is, I'll look at the valuation here in a second, but there's a lot of businesses that really have a lot of flux in right now because of AI or because of government payments, government regulations, or geopolitical things that have really moved all sorts of different stocks around in different directions. I think those are pretty unpredictable right now, pretty much all of them. And so if you're going to find a growth stock, I think it's reasonable to lean towards something that's a little bit more real world, tangible business that probably won't be completely taken over by AI. So Celsius Holdings, if you're not familiar, they make energy drinks. They make the Celsius energy drinks, and they just bought a smaller company too. I always forget the name of it, and they probably won't have it in the summary here, but maybe they will. I'll check. So yeah, I want to say it's like Ali or something like that. I've never actually drank it or seen it, but the kids these days, they say like it. So they made that purchase, and around that time was about the time it bottomed. So, and then started on this rise, which they've come back down to earth here. So we do have a history of these types of businesses doing well. One, we have like Coca-Cola, which is like a soda company, obviously, that goes back 100 years, which does similar things. But we also have one of the best performing stocks of the past 20 years, which is Monster Beverage, which is up, I don't know, thousands of percent. I mean, we can look at it. It split adjusted, it was 39 cents. It's a new high. 18,000% return over the last 20 years. So, and then Red Bull is privately owned, but they've done really well as well during this time period. So Monster is a $70 billion company. Celsius, the young up and comer, I guess they aren't that young. I mean, they went public in 2009, it looks like. But it took them a long time to kind of get traction and earn a profit. And then once they did, then the stock price finally kind of took off. So these guys are only at a $10 billion market cap. So if you think, I think of this as it has a potential to like 5x probably over 10 years or 15 years or something like that. There's still risk, but like there is with any business. And there's definitely energy drink companies that didn't pan out or that sold out at lower valuations. And that could definitely happen with these guys. But compared to, a similar software company or an AI business, or a meme stock or a gambling stock or whatever else people are buying right now, crypto, compared to those, this is a more rational bet, I think. They are earning money. They are growing. Analysts are kind of expecting high teens earnings growth. I'm going to give them like 20% earnings growth when I look at the valuation. This year, earnings grew 182%. So we'll see. They're small, so you're going to get a lot more. Like if you would have bought up here when it was at its peak and held to the bottom. So it fell 75% at one point. And I think I bought it at some point on the way down here, and maybe in 2024 initially. And so it was part of the bubble basically that we had, and had 143 PE. But now we have real earnings. We have real earnings growth. So let's look at, and we know it's at least a business model that has worked in the past for other businesses. That's not super crazy or anything like that. And they've expanded distribution, and they're kind of doing some of the right things that they need to do. So it's more of a question of execution, I think, from here on out, and a little bit of consumer taste, and then just what kind of rate they can grow at over time, which is the risk with any kind of growth stock. So I'm going to use a time until payback method here. So if you're watching my other videos, the idea behind this is if you paid $100 for the business, how long would it take the business to pay you back $100? And you can obviously scale that up to 10 billion or whatever the company costs right now. I mean, we could look and see what the total enterprise value is. They might have taken on they took on a little bit of debt. 11.75 billion. So how long would it take you to earn 11.75 billion back? Although I didn't take in the total enterprise value on this. How long would it take you to earn back your $10 billion if you paid $10 billion for a company? So when I do this, I'm going to use a 20% earnings growth rate, which is a little more than actually what analysts think they'll do, but in the next couple years. But definitely more than, like, even if you just skipped this down year and you went from 77 to 127, I mean, that's probably almost a 20% growth rate, I'd say, between those 2 years. So I think the potential's there, but it's probably going to be in between 15 and 20%. I'm going to be a little more optimistic. I'll show you the 15% rate too when I get done. So I'm just only going to look forward to this year. So I'm not really also pulling forward much. This is 1 quarter or half a quarter, whenever they report next in January, probably. I'm going with this 127 this year. So I'm not really pulling forward hardly any year's worth of earnings, which usually I'll do. So like at the beginning of the year, I'll pull forward from 2026 or whatever. So it kind of just depends on where we're at in the year. So what we need in order to calculate this is the earnings yield, which is the PE ratio inverted, which is right here. So instead of price over earnings, it's earnings over price, and then it's expressed as a percentage. So the way to think about that is that 3.35% earnings yield is like earning $3.35 on your $100. If you bought the business for $100, then you would earn $3.35. Now I'm also going to include, when I do the calculation, 20% growth. So I will pull that forward a little bit. That's just how my spreadsheet's kind of set up. So if we go and look, so that means I'm going to assume you're getting, over the next year, you earn $4.02 on your $100 investment. You get to keep that. And then the next year you earn $4.82 and you get to keep that. The next year you earn $5.79 on your $100 and you get to keep that. And what I want to know is how long would it take for that to build up to $100? And it would take about 10 years if you didn't see it at the beginning of the video. So 10 years is about, with a growth stock, kind of what I'm looking for. If it's under 10, like at just under 9, that's a little bit better. But 10 years is fine. S&P 500, I think, is probably valued at about 14 or 15 year time until payback right now. So, I mean, if they can grow 20% a year for the next 10 years, grow earnings at that rate, then they're probably like 50% undervalued, or 30. It depends on how you look at it. I guess it would be 35% undervalued or 30% undervalued from the wider S&P 500. Also, if they grow a little bit more, they might get included in the S&P 500, which would probably help for sure if they can get some growth going the next few years in terms of just attracting investors and so forth, and maybe even more visibility for their product. If we do, so that looks pretty decent to me, especially relative to everything else in the market. If we do a 15% growth rate, which might be more conservative, we're still looking at a 12-year time until payback. So I think even then you're still a little bit cheaper than what most stocks in the S&P 500 are going for. And while there's always risk with a smaller, kind of newer business and newer brand, it's trying to take on some really big brands that have lots of money. It's probably not as risky as most of the other tech-oriented growth stocks or whatever other risky thing that people are into today. So this will be volatile. We've seen that. Let's go back to the fast graph here. So the stock has traded, it's had sell-offs since it became profitable of about 60% in 2021. And then I showed this one, it was like 75%. And then it's in a downturn of about 40%. So, but I think that if it bottoms in a reasonable future, like reasonably soon, right in here somewhere, I think it might establish kind of a new trend for the stock price. It might fall a little bit more. And now it could fall a lot more, obviously, but this kind of new upswing, it might just kind of establish this new kind of upswing going here. And they have earnings to support whatever that happens to be. So I just feel like we're back here. It was a lot of speculation, I think, on their growth. Now they're earning money. I don't think their basic earnings are much different than, they're not too much different than the adjusted earnings. So, and we have a 33 valuation, which is expensive. They have to grow, and really they have to grow at like 20% for like 2 or 3 years to bring that valuation down, to like 20 or so at the same price. And so during that time, assuming that they can get it done, the stock price can fluctuate quite a lot. And this is the type of stock, when I buy it, I just buy it and hold it, basically, unless something really horrible happens. I would be committed to at least like 3 to 5 years, no matter how crazy volatile it gets, and with like a 1% portfolio weighting. 1% portfolio weighting is what I have now. I've bought it twice now at like 0.5% weightings. So I think this is just a buy and hold. Hopefully they can execute. And even if they don't end up growing at 20% a year, if they grow at 10% a year, they're probably going to do better than most of the market over the next decade, right? So I just feel like the long-term outlook odds are better for them than most of the other stocks that people are piling into at the moment. Okay, there you go. Celsius Holdings. And take a look at it and let me know what you think in the comments. Later.